Hello and welcome to Portfolio Briefings, a video interview series where we discuss the impact of COVID-19 on pension funds. My name is Mona, I'm the Deputy Editor of Portfolio Institutional, and with me today I've got Doug Heron. He is the CEO of Lothian Pension Fund. Thank you very much for joining us today, Doug.
Pleasure, thank you very much for inviting me.
First of all, how are you? How's the whole situation, working from home and everything?
Yeah, I'm reasonably upbeat about it. I mean, we're in, I think, interesting times is the term that is very much overused at the moment. But you know, for a man that cuts his own hair, I think I'm in fine spirit. I'm incredibly proud of the work that my team have done in the last 4 months to I think keep the show on the road, to do what it is that we're here to do, which is pay pension benefits to members. I couldn't have asked for a greater effort there, but no, I'm very well, all things considered. How are you?
Yeah, okay, thanks. It's certainly been, I think we're quite lucky as journalists, we can work from home anyway. Have you and your team worked from home a lot before, or has it been a big shift?
Yeah, I mean, we certainly weren't starting from base camp, if I could call it that. But I think we were probably only just in the foothills of technology. I mean, we had laptops, business continuity arrangements that were pretty good. But I think what I saw is just a remarkable ability to adapt, and many thanks to our technology partners, we were fully equipped, and everybody was working fine within 24 hours really.
Oh, wow.
We had people that needed special chairs for sort of comfort reasons, and we got the chairs out to them. We had some people that needed to have dual screens, and pretty much everybody's got those dual screens. We had some technology that needed a sort of a quirk of a VPN, and again, all within 24 hours. Unfortunately, we didn't solve the problem of one of the team insisting on having an A3 printer, but we just couldn't get our hands on one. So
that's quite specific.
It is, but the paperless spirit does live on, and we've done very well. Interesting times, but no, I'm very pleased with the response.
Okay, and have you noticed that the communication in the team has changed? Are you becoming more efficient or less efficient in all those video calls? Or?
Yeah, I mean, I think it's interesting. We look at the results, which is our KPIs, and I'm almost sort of surprised to say this, but we're actually outperforming our KPIs better than we have for some time. We have had some productivity impacts. A number of colleagues, myself included, are attempting to work and also homeschool their children, which isn't easy. But yet, despite those drags on productivity, we've still outperformed those KPIs, and we've made great progress. This is an important year for us, as we make progress on a number of fronts, but we also contend with the triennial valuation in Scotland as at the 31st of March 2020. So, this wasn't a year that was going to be easy anyway. Introduced the challenges of COVID-19, and you would almost understand if we were struggling, but the simple reality is we're not. So we're doing incredibly well. We've adapted our communication style. Every week I host a number of sort of all staff briefings, and on a Wednesday we even have a yoga session led by one of the team over Zoom, which takes place, and we even exchange cocktail recipes at the end of each week. So we have adapted, and it's really, really great testament to the team that we've been able to do that.
So the team spirit is still there, which is, by the sounds of it.
Absolutely, absolutely. I mean, I think that there is a bit of a reality, which is that as a friendly bunch, working from home probably means you're interacting a bit less with people. So we do encourage people to take a coffee break, which is just simply a case of, I could call you Mona and just say, I'm just having a coffee break, and how have you been and what's happening. So you don't have to have a business reason to call someone. Just keep the conversation going, as we say, and a bit of online digital collaboration as well really has helped. We're not desperate to get back to the office. There's no burning platform for us, but I do recognise that the best sort of team dynamic is one where we've got a bit of physical presence and powerful technology tools to support us working from home. Worlds.
Let's talk a bit about your own background. You actually have a degree in accounting, right? And that's kind of your background. How does it affect your work and your perspective on Lothian's strategy?
That's right. I sort of sometimes describe myself as a former accountant or a reformed accountant, but I don't think you ever leave these things behind. And certainly, I'm still a proud member of the accountancy profession. I mean, for me, a background in accounting, it's accounting and finance. It stands me in really good stead to do the role that I do today. I think ultimately, when you're making investments, you're really sort of taking a very good look at a company's prospects. And what sort of better mindset to be able to do that than a sort of financial one. I've been in roles where I've been responsible for making sure a dividend can be sustained. So I'm pretty good at looking to see how resilient dividend streams might be in a company, but also through things like systems and controls. Ultimately, we pay several £100 million each year in pension benefits. That requires a great system of controls, checks, balances, and segregation of duties. All sort of core skills for an accountant. So very pleased to have had the training, and I think it stands me in good stead to do the role now.
Okay, interesting. And I also noticed about Lothian Pension Fund more broadly that you actually have a large proportion of your investments managed in-house. Can you tell me a bit more about that?
Yeah, I'm happy to sort of say a bit more. The first thing is that we have a high allocation to equities. We are something like 65% on our strategic asset allocation, and some might think that that's high, but just to sort of introduce us a bit more, we're a local government pension scheme. We're a defined benefit. We're open, and so the life of our scheme is effectively, the age of, or the lifetime of the dependents of our youngest member. So however precise you want to be with that, it's something like 100 years. We've got a set of investment beliefs, and number one is that we believe that equities will outperform any other asset class in the long run. In fact, it's true of every sort of period in history, and we certainly believe it will be true for the future. So that's why we have a high allocation, although we think it's the right allocation, not high by any stretch. And there's no way, it doesn't tend to be any tinkering with that. It's a strategic asset allocation. But yes, we do manage most of that in-house, something like £8 in every 10. We're not sort of naive enough to think that all you have to do is have an aspiration to manage investments in-house and the job is done. You actually have to build a team. You have to attract, engage and retain the talent. We've got an investment team of something like 20 people. We've got some analysts, we've got portfolio managers, you've got fixed income specialists. So you have to make sure that you've got the right team and support them with the right tools, access to research, access to trading systems. And then of course the corporate functions, the middle office, the risk and compliance, all of that is required when you're doing something like managing investments in-house. What I would say though is, we certainly don't have any kind of fixed view that we will always be the best team to run all strategies. And if, for example, my pension committee, my investment committee, determined that we wanted to have an exposure to, say, private equity, fintech, then I very much doubt that I would have the confidence to say, look, we want to run that strategy in-house. But instead, what we would do is, we would pick the best provider in the market to operate that strategy for us. And that may be true for emerging market debt or something else where it's not within our core skill set.
Okay, so these kind of more niche, well, it's a bit difficult to call emerging markets niche, but that require a bit more like maybe on the ground analysis or specialized analysis. That's what you would outsource then.
It's absolutely right. I mean, you can imagine that with a team of only about 20, the capacity to operate fundamental analysis on each and every stock is going to be difficult. So, we use the best blend of analytical and quantitative strategies supported by deeper fundamental analysis where we think that it's merited. But we've got something that I kind of loosely describe as a sort of hub and spoke model, or core and satellite, where our core investment strategy is a set of global equity strategies that we run entirely in-house. But we've got a number of satellite strategies with external managers that typically are high conviction, doing something that complements rather than overlaps or duplicates the work that we're doing within our core strategy. So, core and satellite, that's what we kind of describe it as.
Okay, and for example, small caps, I would imagine a lot of the stocks in the core strategy are probably more large caps, and then you could outsource smaller companies. Is that correct?
Yeah, I mean that's a good example. I mean, where we've got something that's highly liquid and a larger mega cap, then we'll typically look to operate that in house, and a good reason for that. Research is typically available, a lot of very good quality corporate reporting, particularly in the US. So there's lots of transparency, and you don't require that sort of interaction with management that perhaps an external manager might insist on as part of a small cap, where your level of conviction must be higher to do that. That's absolutely right, Mona.
Okay, and having a team that manages most of the investments in-house, I suppose you have also a little bit more flexibility to change your strategy if needed, or do you tend to be invested for a longer period of time?
Yeah, I mean, I think it's one of the things I'm proud of, and I think probably the LGPS community at large, is that when investments are made, they tend to be held for the long term. We do rebalance, but the level of turnover at a periodic rebalance is not 100% out, 100% in, because something has marginally moved on a quant screen or something. So we typically hold for the long term. I don't have the numbers in front of me, but typically when we're see a stock as investable, we will hold it for certainly what would be a long term, not a lot of changing. And I think with coronavirus, we obviously saw what we describe as elevated levels of volatility. I think it's probably an understatement, but between November and even continuing just now, at no point did we think that we wanted to radically shift the book of equities that we have. A couple of reasons for that. One is, as I say, we're a 100-year fund. I do invest for the long run, and we understand and accept you will experience drawdowns. We do have a low volatility preference is our style. So typically we will hold stocks that are more resilient in dividend terms and typically attract less sort of less volatility full stop. I think that can mean we slightly lag a rising market, but without performing in a falling market. That's just some of our house views.
Okay, so you haven't, if I'm taking that correctly, you haven't made any broader shifts in asset allocation strategy as a result of the crisis?
Not significantly. I mean, we were pleased to be underweight in equities coming into the downturn, and so that gives the opportunity to actually, increase or accumulate some holdings. And we also picked up, some new lines that we felt were cheap, but not anything that I would describe as large scale tinkering or rethinking. It was just sort of tactical.
Okay. Are you thinking that could be possibly on the agenda later throughout this year, or will you hold off and see?
Yeah, I mean, I try to imagine, what would have to be true in order for us to, drop any of our investment beliefs. I mean, investment beliefs we have are, they're enduring, the long term. I don't think that I would ever think, in a year's time that would be different. The one sort of concern that I do have at the moment is that much of what we do is predicated on, efficient pricing in markets. And the sort of the power behind the fiscal punch today is so great that one might fear that there's market manipulation and dislocations in price, and that could come with, for example, policy responses where unemployment is concerned, where you end up with government ownership of companies. All of these things could come to sort of create dislocation in conventional pricing, and if that were the case, we may take a sort of a look at some of our beliefs. But certainly today, I don't expect to be ending the year with a different set of beliefs or a different strategic allocation.
Okay, interesting. One thing that struck me as well is I noticed that you have a relatively high allocation to real assets. Can you tell me more about that?
Yeah, I mean, I think if you go back to exactly what we do, we are a long-term, defined benefit open pension fund. It's my job to make sure that we're able to pay pensions as they fall due. So what I need is low volatility, stable, inflation-proofed, inflation-linked cash flows. And in infrastructure in particular, but real assets in general, you do tend to find stable long-term cash flows with a degree of inflation protection. So if you imagine your job is to try to match the characteristics of your assets with the characteristics of your liabilities, and perhaps that's the accountant in me speaking again, but essentially real assets do become attractive, and that's things like infrastructure projects, drainage, energy infrastructure, biomass, airports, logistics, a number of different types to that. But we've been in real assets for quite some time, commercial property too.
Okay, I suppose it's something that's really easy to explain to scheme members as well in terms of the long-term benefits, isn't it?
I think that's right, and we take an active interest in some of the sites. We've got a wind farm that's not 20 miles away from where I am today.
Okay.
Pleased to say that not only have I been to that wind farm, but I was able to take some of our stakeholders there and show them that, and actually we managed to climb the inside of an isolated wind turbine, which is quite amazing. Inside, you drive past these things and they look big, but boy, when you're actually inside one, they are huge, and there's quite a lot of electronic gadgetry in there to oscillate the head of it, and to measure the yield, and to determine if it needs to be restricted because it's at risk of sort of over spinning. But there's quite a lot goes into that. But we do take an active interest in these projects, and I'm very pleased that we've been able to use some of our members' money in such a way as renewable energy.
That kind of leads me on a bit to the next question, which is that you recently published your responsible investment principles. Can you tell me a bit more about the key areas that are going to be on your agenda going forward?
Yeah, I think we've always been, a responsible investor, and I think, increasingly in the world that we operate in today, member and other stakeholder expectations for reporting of that have increased. And so in response, we have now, we've launched, first of all, Engage, which is our e-zine, our e-magazine, that sets out just some examples of the work that we do as a responsible investor. And we're pleased that got some favourable comment when we launched issue 1 earlier this year. Issue 2 is in draft at the moment. I'm quite excited about that, but it naturally follows that we would want to make a statement about the principles that we operate to. The STRIP, or the Statement of Responsible Investment Principles, is what you refer to, and some of the things in there, we believe in high levels of stewardship. We believe in operating selectively around the companies we're willing to invest in, but also even things like we're part of a diversity campaign around women on boards. Is something that we believe is an outcome that would benefit corporates and investors alike. So we're active there. And then things like measuring and monitoring carbon intensity of our investments, also big things. But perhaps the most significant thing that we're doing at the moment is around our stance that we will deny any debt to issuers where the project or the firm is not Paris aligned. And that's debt issuance, but it also applies to primary equity capital as well. We think that's the right stance to take, and we hope that others follow us in that.
Okay, do you have certain companies that you're currently invested in that you think you might be divesting from if they're not taking significant steps to align themselves with the Paris Agreement?
I think what I'm saying is, today our stance is that we will not subscribe to any new debt issuance or any new primary capital. I wouldn't go as far as to say that we would divest. I think, for me, when you divest an existing equity holding, you lose the right to talk to management. And I think it's something that's easily done and you move on. But actually, all that happens is that in the secondary equity market, someone else, perhaps less discerning than you, picks up that shareholding, and it's easily the case that management get a free ride. I would rather keep my ticket to the game and keep talking to management teams if they're not Paris aligned. Yeah,
I suppose that applies to quite a lot of firms in the FTSE, for example, that are not Paris in line with the Paris goals. I remember the Barclays AGM and a few others, like a couple of big banks have recently come under pressure. So divesting from them would also basically take out the option of being passively invested in UK equities, I imagine.
It's absolutely right, and I think we do. We spend a lot of time, reflecting on our stance here, and we spend a lot of time engaging with members and other stakeholders around our stance. But I think, when you look at the evidence and you look at the academic studies, and we show exactly the power of the engagement that we have had. Pretty much, everybody gets comfortable that the right thing to do is engage, not divest, and I'm a firm believer in that.
Okay, and are you working with other LGPS boards or other pension funds as well on these kind of ESG issues?
Yeah, we do. I mean, I think, in some cases we recognise that, the direct route is best. If we are a significant shareholder and issues are generally of interest to us, but perhaps not many others, we will engage directly with management. And when we do that, there's a limitation to what one puts in the public domain. Respecting confidentiality of some of these meetings, but more often than not, the right answer for us is to work with others. Yeah. And the two particular bodies that we work with, the first is LAPFF, the Local Authority Pension Fund Forum, and we work with them on engagement, and we also work with Hermes EOS, or Federated Hermes, and they've generally been very responsive. When we've had a concern, and we have some active engagements that we are leading through Federated Hermes right now. But I think typically management respond better when there's 100 shareholders sign the letter, or the body of assets that are being represented is actually in the hundreds of billions, not the single shareholder. So, but again, it's the best route for the right outcome. That's how I would describe it.
Yeah, it's interesting. Would you say that a cross-company collaboration or cross-investor collaboration on shareholder engagement has increased over the last couple of years? Seems to be the case.
It certainly has. In my mind, and quite a lot of things come to my inbox where somebody has identified that we're a shareholder, and they say to us, look, we're unhappy with the use of single-use plastics in the packaging of this product. And I think what we have to do is it's easy to say we would just support kind of every ship that passes, but I think the right thing for us to do is focus on those areas where we want to have the most amount of impact, not to sort of become a factory of signing every letter that comes in the inbox, calling on companies, but we are active and we do spend quite a lot of time. But I think you're right. I mean, just for me, in the investor community at large, there seems to be a significant increase in the appetite to interact and collaborate, and I don't really know if I can put my finger on exactly why that is. I think it's more just people are recognising that the sort of the power of the community is greater than the power of any one constituent, and I'm certainly very pleased to do that. And we do it week in, week out.
Mm-hmm. Well, there's also a cynical take on it if you actually look at how shareholders have voted, and there's a lot of campaigns at the beginning of an AGM, and then when it actually comes down to it, they tend to overwhelmingly vote with the board. And it seems to be quite hard to actually, often then the board comes up with a similar proposal that sort of incorporates some of the suggestions, and that's then how you get the change through rather than through your actual.
I think that's right. I mean, I do recognise what you're saying. I don't think it's widespread, I think, but in many cases, perhaps one of the trends in passive investing over the last decade has been that, those that passively invest lose the right to engage. And, there's the passive investment where the manager behind the investments will vote on your behalf, in which case the shareholder is not voting, but the kind of the agent is. But the worst of the worst is when the passive investment manager running the fund, does not vote at all. And all that's happening there is that, you're kind of giving management, again, a wee bit of a free ride. So, something that we've been quite strong about is criticising, some fund managers who we think are not voting or not taking up the voting rights. One of the things that we did recently is that we looked closely at our practice of stock lending. And stock lending is something that's widespread, particularly in the passive space. And we've decided that we will recall all stock that is lent at the time of a vote. So that's something that is, to my mind, not common practice, but I hope it becomes common practice. So it's almost the proof is in the pudding. We are dropping income in terms of the returns on stock that's lent to recall it in order to exercise our voting rights in full, and I'm very pleased with that step. Interesting.
I think I've seen GPIF was one of the Japanese, they've taken similar steps as well, right?
Absolutely. I think again, I just hope some others follow our example, but it's something that stock lending, it does have some governance weaknesses to it around voting, and we're pleased that we've been able to find a way working with Northern Trust as a partner to Lothian Pension Fund to allow us to vote all of our shares.
Yeah, I think one thing I took from the PLSA, actually, the last one, which was the last time I travelled, actually, since the lockdown started, I don't know if you've been there, it was in Edinburgh, right? So it was
That's right, I was there.
locally. It was that even passive investing is no longer an excuse to abstain from certain issues or to not do any form of shareholder engagement.
It's absolutely right. I mean, for me, passive investing is, there's lots to say about it in terms of cost and in terms of, you get that easy diversification, but, I find it hard to, sort of identify people that hold shares passively as shareholders in the legal sense. But, maybe that trend is changing, and I think you're right, PLSE and others have called that out too.
Yeah, and talking about COVID a bit and its impact on markets, do you feel like there's more of an emphasis now on social issues as well? I feel like there's been a lot of reprioritizing recently, both for households and for the broader economy, perhaps. Do you think that could change the way we understand ESG investing?
Yeah, I mean, it's a fascinating area. ESG is an unstoppable force in the world. I don't know when the momentum particularly accelerated, but it is here, and it dominates pretty much everything that investment managers do. If you're not, demonstrating your ESG credentials, then you will be called out for that, and you will be made to change. So, we are willing, willing to engage in ESG, but it has all been about the environment, and that's certainly, for me, it's been about carbon, it's about stranded carbon assets, it's been about, pollution, and, now for me in the last 6 months, the S, the social, has become, again, right to the sort of front of mind. There's some crazy things going on right now around, companies that are, being scrutinised for their treatment of employees.
Yeah.
Sadly in the UK, there's been 4,000, job cuts announced from trusted brands, and I'm pretty sure that the management teams behind those trusted brands will not have looked at that as a P&L exercise. I think they will have recognised and quantified how much of an impact it would have on their brand. The social media campaigns at the moment around, where brands have not helped their staff to socially distance, or where brands have brought in, I think public domain Boohoo is now, front page news, where you've not put in place safe working practices, then you will suffer as a commercial organisation because of that, and that's the power of the S. But also, it's interesting for me, some of the sort of great headlines that I've seen are around, companies that have, taken their machinery and repurposed it into making PPE that they've not charged for, and they've donated to the NHS, or breweries that have been making hand sanitizer for care workers. So I'm just absolutely thrilled that there are two sides to the S. There's companies at the moment that are responding almost with a little bit of that sort of fortitude that is essential in any recovery, and there's companies perhaps that are putting not profits first. There's also for me an important analysis still to come around the extent to which companies drew down on furlough and then increased dividends. We as an ESG investor, responsible investor, will be looking closely at any examples where a company has taken government money when it's not been required and then grown a dividend on the back of that. I don't think it'll be widespread, but companies will have to make sure that they don't draw down on public funds when they're not required. That's, for me, again, part of the S. But will the E return to centre stage? Quite possibly, but for now it's all about the S as far as I'm concerned.
Okay, interesting. If we take a step back and look at the impact of COVID on the broader economy and in the financial sector, I mean, looking at stock markets, it seems like things are going a bit better now. Do you think we're on the way to recovery, or do you still see some key risks, investment risks particularly?
Yeah, I mean, in cases, questions like this, I find it quite hard to say something original. There's sort of widespread, commentary out there about views on, are we seeing a dead cat bounce? Are we seeing something that is a return to confidence? And where will the confidence, be first, or where will the recovery be first? Will it go west to east or east to west? And I think, for me, I think markets, overreacted and then have priced in, some better news. But again, it's the power of the fiscal punch for me. At the moment we are in, to use that a term, uncharted territory around, just how an economy recovers after such significant liquidity support. The one thing that governments around the world seem to be is to be deeply averse to social unrest right now and to unemployment. So you might see governments, again, subsidising jobs. In the UK we have a chancellor that wants to pay a job retention bonus, but only until January. It remains to be seen what other central banks and governments do around the world, but that will determine for me the shape of the markets for the next 5 years. And at the moment, I find it hard to call that with much certainty. But as a long-term equity investor, to perhaps use that term again, it doesn't change what we do, but it might mean that we're in for additional volatility in the next 5 years, rather than being 6 months away from a recovery, so to speak. Yeah. A particular risk for us is around inflation. We do recognise that it's probably in central bank interest to sustain a bit of inflation, and that inflation is usually a natural outcome of such a public finance responses as we've seen. Mm-hmm. So let's see what happens with inflation as well. But I would call that it's a structural risk in the economy.
Okay, inflation is an interesting one actually, because that could have repercussions on debt then, I guess.
I think that's exactly it. No matter how much debt is issued at the moment, there seems to be a buyer for it. Yeah. I don't know what that says about security or flight. I don't know what it says in terms of the credit stack. I don't know how that sort of flows through in terms of higher grade corporate as well. But at the moment, it's quite difficult to get a secure return or a stable return that outperforms inflation, and that's with inflation where it is. If it increases, we just might be in for a period of lower returns across all asset classes.
Okay, so hence the very cautious stance from your side in choosing not to conduct any major changes to your portfolio. A bit more of a wait and see attitude, I gather.
I think that's right, but I do think there are opportunities too. Who would have thought, in the UK in particular, that people could be working outside of office environments in the way that they are. Who would have thought that some of these micro enterprises could come up with digital delivery? Universities, colleges switching to delivery of lectures, schools as well through a video conference, but also even things like yoga sessions. How many people are doing Pilates and yoga by Zoom? Who would have thought that was possible? Yeah. The Pilates and the yoga teachers of the UK should not have suffered because of this. If anything, they'll have gained. So, there are opportunities. We're becoming more productive, and the UK's had a sort of long-term deficit to other countries in terms of our productivity, and maybe the sort of digital infrastructure, the digital behaviour, the technology adoption of the corporates will stand us in good stead there.
Okay.
So opportunities as well as risks, I would say, Mona.
Okay. Well, that was very interesting. Thank you very much for that, Doug.
Pleasure.